International is buzzing in trade. This is after the company secured orders worth nearly 1,000 crore across its various businesses. The company has secured so far, year to date, orders worth 10,000 crore rupees. Though their guidance is that for the full year, the company will see order inflows of nearly 25,000 crore rupees. But the second half of the year is typically much stronger in terms of order inflow. So can the company achieve their full year order inflow guidance of 25,000 and even the revenue guidance of 12 to 15%? We're joined by Vimal Kejriwal, the MD and CEO of KEC International. Mr. Kejriwal, morning, and thank you very much for joining in. This is Rima here. That's the first question, right? Congratulations on the order win. But are you on track to achieve your order inflow guidance of 25,000 for the full year? And what's the bidding pipeline and order pipeline looking like?
Well, thank you for having me, Rima, and good morning. I think as we have been maintaining that we should be able to reach our order guidelines, have an L1 of almost close to 7,000. So assuming that, the whole thing gets converted, we'll be at 17,000. So then it's almost just 8,000 of new orders. And if you look at the pipeline, we have a pipeline of close to 1,25,000 crores, both domestic and international, of which largely I'll say 75,000 or so would be in the transmission and distribution spread across India and outside. So I think we are pretty okay with our guidance of, 25,000 crores.
And what about the revenue guidance of 12 to 15% and your margin guidance of 8% in the second half of the year? On track?
I think we are on track. I'll say give or take 10 basis points here and there.
Okay.
I think we should be more or less on the numbers, on the margin. Revenue, I think we are comfortable. We had said that we should cross around 20,000, which should be anything, I think close to around 15%. So I think we should be okay with that numbers.
Mr. Kejriwal, hi, good morning. Thanks for joining in. So give us some more perspective on where the margin expansion is coming from, the profile of orders, the sort of works that you're executing in the markets that you're in, because it's a significant increase, right? You're above 6% EBITDA margin in the second quarter, and you're sticking to that guidance of going up to almost 8% this year. So what's happening with the mix and the geographies?
So Surabhi, a slight correction. What we have said is 8% for H2. And overall, we are saying probably for the year should be around 7%. That's the numbers which we have been talking for. I'll say there are 3 or 4 reasons. One is in the last 2 or 3 years, we had significant losses in our Brazil subsidiary. That is behind us. The subsidiary is now making money. So that part is one. Second is we had a lot of, I'll say, negative numbers coming out of the metal prices, be it aluminum, be it steel, be it copper. So I think most of that is now again behind us. We have closed most of the orders or the losses have been booked. So I think these are the 2 major parts. The third part is that with the large, I'll say, order pipeline and the tender pipeline, we have been becoming much more choosy about the quality of the orders which we take in. And so slowly, we are seeing the margin levels of the orders which we are getting are inching up. So as and when the new orders start getting executed, automatically the margin profile starts picking up.
And just give us the mix right now, India and global in the current order book, along with the new orders that you won.
So typically our India order book is around 70% and 30% is international. And then the major reason for that is that international right now, we are mainly only in T&D except for a large order in railways. So once we start doing civil and other things internationally, the international will pick up. But broadly, it is 70-30. And if you look at business-wise, then T&D would be roughly 50%. The rest would be between railways, civil and cables.
Sir, you said the L1 order status is 7,000 crores, right? As of September, yes, it was a 4,000 crore number. So that's the increase that we've seen in the last 1.5 months.
You're right, Rima.
Okay, and that should convert before the end of this financial year. And plus, you're expecting new orders of 8,000 crore. What about the debt position? Your debt increased 7% on a year-on-year basis in the quarter gone by, September ending. It stands at 6,300 crore, roughly. What's the outlook on debt reduction?
So I don't see any significant reduction in the debt as such during Q3. But as we had said earlier, our revenues will go up significantly. We have been talking about 8,000 odd crores of revenue in H1 and around 11,000 crores of revenue in H2. So the interest cost as a percentage of the revenue will go down. So right now we were in Q2, we were at 4%. We are expecting it to be around 3% or so in Q4. and maybe 3.2 or something in Q3. So overall, I think we'll have a 75 or 80 basis points reduction in the interest cost to revenue.
Okay. And that would result in annual interest savings with the reduction in the interest cost?
So there won't be a saving in the interest cost because with the growth of 30% and all that, I don't see debt going down immediately. But as I said, as a percentage of revenue, it will go down.
Okay. Just a quick final question, Mr. Kejriwal. You said 70% of the order book is in India. How much that is government orders or government-related entities, whether it's railways or anything else? Just asking from the point of view that because we're getting into sort of election season next year, so just trying to understand the any volatility that event might just bring.
So, since we already have the order book, I don't see any significant volatility in the execution part of it. Because typically,
in terms of incoming orders, just wanted to understand how much was from government so far this year, and then maybe next year turns out to be timelines may get varied as we go through the election process.
Honestly, I don't have that number, but let me just give you a small breakup. See, we have transmission, we have civil, we have railways. Railways is generally all government. Okay, civil is largely private, except if you get into metros. Right now, we don't have any metro new orders, so most of our orders in civil are also now private. T&D is the area where you are more dependent on power grid, etc. And we have seen that power grid has also increased their capex assumption. So I don't think, are we worried about this? I don't think we are significantly worried about the election impact. In fact, what we have generally seen is before the election, a lot more orders are actually placed.
Okay, sounds good. Then explains why you're really optimistic and have those great-looking targets as well on both order book growth as well as revenue growth. Thank you for joining in. Appreciate you being with us on the show today. That is a word coming in from KEC International. We do have to take a very quick break on that note. Back with